Welcome to Module 2. We have built the foundation of how options work. Now it is time to put real capital on the line by mastering the long call, the most straightforward directional strategy in our toolkit. Let's set up a real-world scenario. Apple is currently trading at $185. Based on our analysis, we expect a bullish breakout, pushing the price up to between $195 and $200, right before an upcoming earnings report. This T-chart compares our two choices for acting on that thesis. On the left, buying 100 actual shares of Apple requires $18,500 of capital, all of which is technically at risk. You can hold those shares forever and collect dividends. On the right, buying one call option contract gives you exposure to the exact same 100 shares, but for a strict maximum risk of only $400. That is a 46-to-1 leverage advantage, but it comes with a 35-day limit to be right. Shares are built for long-term ownership and patience. Calls are precision instruments.
You get high leverage and defined risk, but you must overcome that strict expiration date to turn a profit. When we open the options chain, we face our first critical decision, choosing the expiration. A cheap 7-day weekly option looks tempting, but you should almost never buy these. Time decay is so aggressive in that final week that it will destroy the value of your position before your Apple thesis even has a chance to play out. Instead, apply the buyer's rule of thumb. Buy exactly twice the time you think you need. Since we expect the move to happen in a couple of weeks, we will slide down the chain and select the contract with 35 days to expiration. Next, we select a strike price. We will isolate the $185 strike. Because this exactly matches the current stock price, it is an at-the-money option. This strikes a balance of cost and probability for standard directional trades. By giving yourself an adequate timeline and choosing a realistic strike, you protect your capital. You avoid the trap of treating options like cheap, low-probability lottery tickets. This trade dashboard shows our exact entry parameters. We are paying a premium of $4 per share, which equals a total cost of $400 for the 100-share contract. Before hitting buy, we check our Greeks. We have a delta of positive 0.50, a gamma of positive 0.04, and a negative theta ticking down every day. Look at how delta and gamma work together here. Because of our positive 0.50 delta, if Apple's stock rises by exactly $1, our contract immediately gains $50 in value. And thanks to gamma, every subsequent dollar the stock climbs increases that delta, accelerating our gains as the rally continues. Let's pause right here and test your math. Based on the $185 strike and the $4 premium we just paid, what exact stock price do we need at expiration to break even? The answer is $189. As an options buyer, you start every single trade in a mathematical hole.
Apple has to climb $4 just to clear the hurdle of the premium you paid, allowing you to walk away with zero loss. This step chart plots Apple's possible stock prices against our final profit and loss. If our thesis plays out perfectly and Apple hits our $200 target, we generate a 300% return on our initial premium. If we get a modest gain up to $193, we still secure a solid profit. And as we calculated, if the stock only manages to reach $189, we hit the break-even zero line. If our thesis is wrong and Apple's stock crashes down to $160, our losses do not scale infinitely. They hit a hard floor, strictly capped at the $400 we initially paid for the contract. But here is the danger zone. If Apple stays flat at $185, we suffer a 63% loss by expiration. The daily drain of theta simply eats the premium away. This flat stock trap reveals the reality of buying calls. Time is your enemy. You are fighting a two-front war, requiring both directional price movement and rapid execution against the clock. Professionals do not buy an option and just hold it, hoping for the best. They actively manage the trade by establishing strict mechanical exit rules the moment they enter the position. You manage the trade with a sell-to-close order. You lock in profits by closing the position at a 50 to 100% gain. On the downside, you trigger a stop loss the moment the option loses 50% of its initial value, preventing a total wipeout of your capital. You also have to watch out for events like earnings. Implied volatility rises heading into the event, inflating option prices. If you hold through the actual earnings announcement, that volatility collapses instantly. This IV crush shrinks the value of your premium, even if the stock price moves up. Correctly predicting the stock's direction means nothing if you allow a sudden volatility collapse to strip away the extrinsic value you paid for. When managing these trades, timing your exit is as critical as your entry. You should almost always close the position early and rarely hold a directional call inside the final 21 days to expiration. Inside the 21-day window, theta decay accelerates, bleeding premium dry. Late-stage gamma risk creates unpredictable price swings from small stock movements. Selling early captures the remaining time value the next buyer pays. If you wait, that value bleeds to zero. Let's consolidate everything into 5 core rules. Require a strong catalyst, give yourself 30+ days to expiration, buy at the money, keep your position size under 5% of your total account, and execute your mechanical exit rules without hesitation. Now that you know how to leverage defined risk to profit from a rising stock, it's time to learn the mirror strategy. In our next video, we will cover how to profit when a stock crashes. You now have a repeatable process for trading a long call. Now, let's master the bearish side of the market.